Money Saving Monday. If you're a person who pays attention to the stock market, you know we had a heck of a ride last week, right? Markets here in the U.S. and other parts of the world having one of their worst days in years, followed by one of the best days. So recession fears, some jobs data were to blame at the time. But let's bring in an expert to talk with us, Charlie Shields. He's a financial expert, works with our Treasury Department here at the state. So good to see you, Charlie. Good to have you on board. So number one, is watching the daily swings of the stock market a good thing to do?
No, it's a recipe for high stress and disaster and irrational moves. People will listen to the data coming out in the news, and on a daily basis, they'll make decisions that they probably wouldn't make had they not heard that. And those situations can change very quickly, and they do. So the best course of action is to remember why you have your investments and to stay the course with those and not pay attention to the day-to-day blips.
Because you can get tempted on a bad day to say, oh, I gotta sell, I gotta get out. Most of us are exposed to the stock market, most normal workers, through their 401ks, right? Right. Okay, so if you have a 401k and something like this happens, what do you do?
Well, human beings by nature panic. And when they panic, they make quick decisions. They're snap decisions. You have a 401k, and if you're middle-aged or you're in the middle of your career, stay the course. Make sure that your allocations are in place for your goals down the line. And if you're a person who is retirement age or near retirement age, take a hard look at your income needs. Talk to your financial advisor and make sure that your portfolio is in line with the income needs you have. Your allocation mix should be correct. The 60-40 rule does not always apply to everybody. That's 60-40 stocks and bonds.
Stocks and bonds, which is more conservative, correct, as you're getting near the end of your career?
Yes. But the financial advisor will give you a headline if that's where you need to stay. Really, one of the most important things that they can do, anybody who is midstream or retiring, is to have their financial advisor stress test their portfolio, which is a simple simulation that almost any financial advisor can do, which mimics a market drawdown. So they can then determine, where would I be if we had a 10% correction or more?
That sounds unpleasant.
It does sound unpleasant, but it's also highly possible.
Right.
Yeah.
Because we've had a great couple-year run in the market, haven't we?
Absolutely.
And so that doesn't last forever.
Right. If you take a look, we have now gone, for about 15 months, from February of 23 until this past third week of July, we went 15 months where the S&P did not have a day where it closed down more than 2%. That's the longest stretch in 17 years. So at some point, the market's it's like a rubber band. It's going to get stretched, and then it's going to eventually snap. But then you have to remember, and very few people think about this, August and September are notoriously light volume days. All the pros are on vacation. So you have light trading days, little volume. So when something like this situation happened last Monday, which was precipitated by a geopolitical event for the most part in Japan, it triggers selling that is exacerbated by light volume, right, on the market. So this selling may not actually have been, the market's drawdown may not have been as intense had the volume been higher and people had been...
So a smaller event because there's less...
Correct.
...had a bigger impact. Yeah. Charlie, thank you so much for being here. So stay the course.
Stay the course.
Everything's fine.
Yeah,
buy and hold, stay the course, bet on the American economy.
It works.
Thanks.
All right.
Appreciate you being here.